Okay, it looks like everything is running. Welcome to the Director's Cut, December 14th, but we've got October production information, and the dates for 2021 Director's Cut are posted to the Information Center on the Oil and Gas Division's website. So if you're looking for those dates to just pencil them in on your calendar, those are available now. Of course, subject to minor changes if things come up, but please save those dates. Otherwise, I will send it over to Lynn.
Thanks, Katie, and thanks to everyone who's tuned in or turned out for December Director's Cut. Looking back at the month of October, we'll start with crude oil production. It was as flat as you can ever see. It changed by 236 barrels a day from September to October anyway, so it was down 236 barrels a day. I think this is exactly what Justin and I had been talking about and predicting, was that that resurgence that we saw July, August, September, it's pretty much over with. And so essentially all of the shut-in production has been put back on, that's economic to put back on at this point. And so we hope to plateau and hold this production level. As you know, the revised revenue forecast is 1.2 million barrels a day. So we're just a little bit above that, which is where we want to be. We'd like to have a little more breathing room, but we're happy to be above the revised revenue forecast, which will take us through the end of this biennium, June 30th of next year. Natural gas, though, actually increased. So even though oil was absolutely flat, natural gas production was up 2%. And that's kind of the history of the Bakken and Three Forks reservoirs. So we are starting to get into the phase where we see enough reservoir depletion that gas oil ratios are increasing, and new wells are coming on at higher gas oil ratios, and so gas production was up. The great news was that even though gas production increased by just about 70 million cubic feet a day, was up 2%, industry was able to hang on to that 93% capture number and not lose ground, or only a very small amount of increased flaring, I think about 13 million a day. So industry has the infrastructure in place and is learning how to operate it very efficiently, and so didn't lose any ground on gas capture. You know, well permitting is pretty volatile. It's up and down all over the place, depending on oil prices. We really need to see $55 West Texas oil to see a significant increase in permitting and rig counts, and we're well short of that. I think I made a comment that OPEC Plus met last week, and they decided just a week ago that in January they're going to bump their production up. So they had cut 7.7 million barrels a day. They're going to back off of that a little bit in January and test the market. And again, I think part of the strategy there is that they're okay with U.S. production coming back online, and more or less okay with DUC wells being completed, but they don't want to see a resurgence in rig count or in drilling wells. And so they're looking at trying to keep oil prices below that $50 mark so that they don't stimulate a resurgence in drilling in the shale plays in the U.S. Completions, well, I'm sorry. Yeah, so when we look at the rig count, sitting at 15 today, but one of those is on a carbon storage well, so it's actually 14 drilling oil and gas wells. That's probably 20 rigs short of what we would need for a sustained, 70 well completions a month for long term. And so again, we're very much looking forward to that day, probably not next year, but the following year, when we can add those 20 drilling rigs and get back to steady or increasing production. waiting on completion wells down about 70. You saw the work that Justin had done, and I'm not sure, I didn't look at his slides to see if he's going to touch on that again. But we need to tap probably 440 to 450 of those wells if we're going to sustain our oil production at 1.2 million barrels a day. So we have an inventory to draw on. We have an inventory of high quality wells in highly productive areas. And so, and at today's $47 West Texas price, those should be economic on their own. So the CARES Act incentive was designed to carry us through November and December. We're approaching that January timeframe when we need oil prices that will sustain duck well completions on their own, and we're actually at or a little bit above that price point of $45 a barrel. So that's some positive news and good news for the holidays. Also, inactive wells down significantly, below 3,000 for the first time in months. And so again, we're watching that number very closely, and we are pre-filing a bill through the Industrial Commission to deal with tightening up the bonding regulations on abandoned wells. So if we start to see a significant number of these wells jump from inactive to abandoned, this new legislation would kick in and require full plugging and reclamation bonding of every one of those wells that would flip that switch. And so we're pre-filing that and be watching for some discussion about that when the legislative session rolls around. Completions, some decent numbers, but again, still at 59 completions in October, that puts us a good 11 wells short of enough to sustain production. So we could actually see a little bit of production decline in November and December, but it looks like the numbers are strong enough to keep us above that 1.2. So, and hopefully we'll actually see an increase in November and December as a result of the CARES Act funding. Our indications are that should have added 4 or 5 frac crews to the crew count out there. And so we may actually, and we're hoping when those numbers come in for November and December, that we actually see that uptick in completions that'll help us sustain production. So production and rig count on Fort Berthold up significantly, different than the rest of the state. Rig count increased by 2 and production up significantly. So that's, you know, a positive sign for the core part of the Bakken. When you look at the chart, do you put the charts on here, Katie? You don't?
Yes.
Okay. The one really significant concern that I have is that that chart you see on the left there, U.S. crude oil stocks. We had been coming down all year long, well, since the middle of the year, and we had actually gotten down to the normal range for crude oil in storage in the United States. And then this last week, we had almost a 16 million barrel jump. And so the concern about not enough vaccine, delayed rollout, what is going to happen transportation-wise and travel-wise over the holiday season resulted in a significant slowdown in terms of refinery runs. And so that is not a positive sign. That's the sort of thing that can lead to a significant price drop on that WTI price strip, and then that in turn can lead us to declining numbers of completions and hold that rig count down. Couple last things to talk about. Gas capture held even with a 2% increase in production. The place where we lost a little bit of ground, and like I said, we did see a slight uptick in the volume flared. I think it was 13 million a day, and that happened on Fort Berthold. and it happened dominantly on the trust lands on Fort Berthold. So again, it's constantly lagging the off Fort Berthold numbers and the statewide numbers, and that really is an area where we're trying to get people to focus on building infrastructure and also implementing some remote gas capture ideas. And I think you're going to see some proposals or a proposal in the legislature to provide some additional incentive for people to use some of the scalable remote gas capture technologies like the Crusoe, the Bitcoin mining, and server storage. That particular technology is the most scalable of any of them, and it's got a few other side benefits, and so I think we're going to see some legislation along those lines. Also, the Industrial Commission along these lines is or has pre-filed a bill to take on permitting of natural gas storage and storage of natural gas liquids. And those are two critical infrastructure pieces. So the way it would work as it's written right now is it would require the same percentage of surface owners to sign on as we use for unitization of an oil or gas field. And if 55% of the surface owners lease their pore space for a gas storage project or for, say, salt caverns for natural gas liquid storage, then the Industrial Commission could put together a facility and what we call an amalgamation or a unit to pull all that pore space together and provide for the gas storage or natural gas liquid storage. So we have a vehicle to move forward. There's a report due from the EERC by the end of this month that's going to be presented to the legislature. Well, actually two reports. There's a report on the progress on natural gas storage. They got $6 million to fund that work during this biennium. And then there's another report on salt cavern storage potential in North Dakota that was funded through the Industrial Commission through some set-aside funds. I think it was $300,000 or $400,000 to fund that study, and those will both be coming out either by the time the legislature fires up or the very first week or two of the legislative session. So we at the commission pre-filed a bill to give a venue or a place for those recommendations from those studies to go. And then just one last item, the Dakota Prairie Grasslands, the new Dakota Prairie Grasslands manager signed the record of decision for the leasing final EIS a week ago today. And so that's out there. We have requested the map coverage of that, and so we're going to put together a series of maps here at Department of Mineral Resources that allow people to compare that alternative 3B that was signed with drilling units, spacing units, and to the extent that it's public, with underground gathering pipeline systems, so that we can, I guess, bring those two things together. So, you know, as they make changes in the availability of mineral leases, we want to make sure that when we set up drilling units or spacing units for accessing those minerals, that we're consistent with no surface occupancy and timing restrictions and controlled surface use. So that final EIS record of decision was signed a week ago, and those maps will be coming out fairly quickly as soon as we get the map layers from the Forest Service. That's what I had to say. So I'll be happy to try to answer questions.
Yeah, go
ahead. Just a question about salt storage. Is that normally near the Williston area where the salt caves are?
Yeah, thanks, Dave. So the question from here in the room was salt storage, is that normally near the Williston area? This would be very different. There was salt mining right outside of Williston. Hardy Salt for several decades actually mined and sold salt from the Charles Formation right outside of Williston. That facility's been closed and has been reclaimed and fully remediated. The best prospects based on our geology research are, somewhere between Williston and Minot, somewhere along the pipeline infrastructure corridor and the rail corridor, and the 4-lane of Highway 2 is the best place to put them. So you need a large workforce. You want a 4-lane highway, you want a railroad, you want pipelines to move natural gas in and out, and natural gas liquids in and out, and all of that exists on the north side of Lake Sakakawea between Williston and Minot. So where it would finally land is going to be, up to the people that actually go out and drill the wells and do the construction. But it looks like from the very preliminary work that it is feasible within that corridor, that we do have the geology to support it.
So the end game on that is to store it until there's a market, perhaps, correct?
Yeah, so the question was, what's the end game? And so there's really two things. One, of course, is to store natural gas until there is a market for it or facilities to process it. And so part of this project will deal with pore space in saline formations like the Broom Creek or Dakota, where you could temporarily store unprocessed natural gas and, reduce bottlenecks and reduce flaring. But we also think that the statute changes and the rules that would come with them would provide for engineering and design and construction of large caverns in salt formations. And those are typically used to store the feedstocks for petrochemical and the petrochemical products themselves before they're shipped to market. And typically you need millions of barrels of storage, and you can't normally do that, especially for these kind of chemicals or materials on the surface. We're talking about storing something that we call ethane, and ethane doesn't really want to be a gas, and it doesn't really want to be a liquid. It has some really strange physics properties, and so depending on temperature and pressure, it is very, very difficult to store and work with. So salt cavern storage is the current way worldwide that folks deal with ethane.
I was going to ask you about the Forest Service and the grasslands,
Mm-hmm.
which you kind of beat me to my own question, but I was just curious what you make of what the Forest Service did. I'm not sure if the state maybe submitted comments during that process, just what your thoughts were on it.
Sure. So the question was thoughts on the Forest Service final EIS, and we're pretty pleased with it. We did comment, the Industrial Commission did comment during that process, and it was a multi-year process of putting that thing together. And as it turns out, a lot of discussions with the Dakota Prairie Grasslands Management, and the previous record of decision contained lots and lots of controlled surface use and things like that. It was found that those were super hard to work with, that it didn't really provide the flexibility that the grasslands manager needed to deal with mineral leasing applications and applications for surface use permits. So they took a look at how to modify that and actually convert most of those controlled surface use things, or a lot of them, to no surface occupancy, and then some small percentage to be converted to open access, so that using horizontal drilling, industry could reach under the no surface occupancy. So for a large part of the lands under question, the restrictions were actually tightened from controlled surface use to no surface occupancy. And then for some small areas, to make it accessible using horizontal drilling, they were loosened from controlled surface use to standard surface use terms. But the vast majority of the changes were in a tighter direction. So yeah, I think we're pretty pleased with them. We spent a lot of time working with them on reasonable foreseeable development scenarios, and the ability of the technology, drilling technology today, to be able to access minerals remotely. And so that had a lot to do with the final decision. So we're pretty happy with it. That's my thoughts. So.
One other thing, it's more of a general question, but could you maybe provide we're getting to the end of the year, could you provide kind of a look back at how you feel 2020 went for oil and gas, and maybe a look ahead at what you're expecting next year?
Yeah, thanks. So the request was for a bit of a look back at 2020 and a look forward to next year for the oil and gas industry. And I think I have to start by saying that this was probably the third worst year I have ever seen for the oil and gas industry. The overproduction and the economic collapse that we saw in 1999, 2000 was worse. We actually saw lower North Dakota crude prices that year than we saw this year, and we actually got down to 0 drilling rigs. Also, if you look back to 1985, 1986, that was a worse and probably longer term price collapse, in that the state went from roughly 150 drilling rigs down into the teens, whereas this time, we went from the mid 50s, or from 60 down into the teens. So still very severe and really economically distressful. But I'd rank it number 3 out of all of them that we've seen over the 40 years that I've been in the oil and gas industry. Having 1.5 million barrels a day to work with was wonderful, because we could handle a major shut-in and resurgence of production. Having the infrastructure in place to deal with the crude oil transportation without much disruption, and the natural gas production pretty much maintaining, even though crude oil production fell, were big positives. But all in all, though, a pretty terrible year for the industry. And as we look forward into next year, it doesn't look very promising in terms of growth. I think we have to get out more than a year, maybe a year and a half, before we have the prospect of seeing oil and gas prices that will result in sustained growth. And a couple of things that are going on. One is that the demand destruction that occurred due to COVID is not going to correct itself until late next year, or maybe early 2022. So we're not going to see a return to demand growth. we don't get back to 2019 demand levels until late next year, if not into the first or second quarter of 2022. And then the world has refocused a great deal on something called ESG. And so environmental, social, and governance have become a really enormous part of what the investment community looks at. And so industry is going to be forced to refocus its efforts on lowering its carbon footprint and getting ESG policies in place. And that's going to create a lot of financial stress. So next year, this industry is going to be stressed on the investment capital end and the market end. The investment capital end by ESG requirements, and the market ends by the demand destruction that will still not have recovered from the COVID-19 pandemic. So it'll be a better next year than it was this year, but this industry is going to be very stressed on both ends of its capital stream. So it will be a lot of work just to hang on to the 1.22 million production number.
Well, you brought up petrochemicals briefly. I'm just curious. I would assume the pandemic has kind of stopped any development or any talk about that. Do you see that coming back anytime soon?
Yeah, thanks. So the petrochemical idea and the demand, what does the future look like for that? And you're right, Dave. The pandemic has really resulted in a lot of demand destruction. And so some of the big projects that people moved forward in 2019 don't have very good economics for 2020 or 2021. So, Shell's big project in Pennsylvania is going to struggle for a year or two before demand returns for petrochemicals. And then on the ESG side, the demand for lower carbon transportation fuels and lower carbon transportation is going to be a major stressor. But we do see returning demand in the petrochemical area probably in 2022. What we need to keep in mind is that even as we shift to electric vehicles and those kind of things, we're going to shift power production to things like methane and ethane, and most electrical vehicles are, well, they're more plastic than they are metal. And so we're going to see a significant shift and demand for petrochemicals, even as with the ESG demands are met. So I think we're going to see the investment community look at petrochemicals as a good long-term investment place to go to meet their ESG requirements. And we're going to see, like I said, some of those petrochemical feedstocks and products be part of the electrical demand or the electrical generation side of things. So, so absolutely, we see that returning around the same time that we see liquid fuels demand coming back.
On that note, are there ways in which Bakken producers are trying to meet the ESG demands? Are there things that actual oil producers are doing here?
Yeah, so the question was, what are Bakken producers doing to achieve some of those ESG demands? And I think you saw ExxonMobil come out with a major statement today, and they are the mothership of one of our major Bakken producers, XTO. And so those demands are going to trickle down through that organization all the way to the producing company. Likewise with Equinor, the former Statoil, they're heavily engaged, and they've been having a lot of conversations with us about how to bring their flaring and use on lease for fuel numbers down so that they can reduce their carbon footprint and get to ESG. And I think you're going to see in the legislature a major push from the people who are like part of Empower and part of the existing research organizations to put together an organization that will be focused on moving North Dakota forward in terms of clean, sustainable, low carbon fuel production in the renewable areas and in the traditional fossil fuel areas. So there is a lot of activity right now to move things like PCOR and Bakken production optimization and the efforts over here at Minn Kota and up at Northwest Ag or Midwest Ag and Red Trail Energy, all towards low carbon, towards carbon capture and storage, towards utilization of our CO2 for enhanced oil recovery. There seems like we talk about it every day. So the focus has really shifted in that direction, more so than in the direction of growing production.
I do have one, shifting gears a little bit, question that came in online. Do you think we'll see a connection at all to production now that North Dakota will get vaccinations coming in? Could that have any effect, or maybe very little?
Yeah, so good question. There have been some issues with oil and gas crews and COVID-19. It's created some struggles for us in our plugging and reclamation program, and a little bit on the particularly on the duck well frac program, with some crews being idled. However, I don't think they even appear on the vaccination schedule at this point. I think the number of vaccines that are available is going to be completely absorbed by our healthcare system and our older population and that sort of thing. And so more likely where we're going to see some help for the oil and gas industry is in the rapid testing side of things. There's a lot of new technology and new rapid tests becoming available, and that's going to allow them to identify and isolate people that test positive more quickly and make sure that we don't have entire crews or multiple crews taken out of the system. So not so much from the vaccination, a lot more so from the rapid testing.
Okay, on that note, I was at one of Governor Burgum's press conferences, I don't know, a month or so ago, and he announced it sounded like some pilot projects to try to use all of these rapid tests that the state has from the federal government. Do you know if any of those are being used in the Bakken, or like if there are rapid tests being used out, in the oil patch, where those are coming from?
Mm-hmm. Yeah, so the question was the rapid testing that Governor Burgum talked about, and it has been implemented a lot in the Bakken. So I know that all 14 of our drilling rigs are using rapid testing for everybody who visits the rig site, as well as for the crews coming on and off. And all 7 of our frac crews are utilizing it. And at one point we had even talked in the Bakken Restart Task Force about whether we should redirect some of the Bakken money towards the rapid testing, but industry really had essentially already implemented it. And so I think a significant amount of what the governor was talking about is actually happening in the oil and gas business at the gas plant construction project that's going on up at Williston, and at all of the drilling rigs and all the frac crews. They've all implemented it.
And do you happen to know, are those I think it was like 200,000 roughly tests that North Dakota had secured? Or do you know if the industry actually securing their own tests? Do you happen to know?
I don't know the answer to that, Amy. Sorry, I'm not sure. I think that they had applied for a significant number of the state tests, but I know that the state also was giving priority to school systems and to healthcare workers. So I don't know if they were able to make any of those available or if any of those were available to industry, but I know industry's been buying rapid tests like crazy. So.
All right.
Thanks, everyone. Happy holidays.
Position it where you can see it. Ready? Okay. Well, good afternoon, everyone. Justin Kringstead, Director of the North Dakota Pipeline Authority. We'll get right into what's happening in our neighboring states in the Williston Basin for crude oil production. Eastern Montana down slightly from the August to September timeframe. Not a surprise. The last couple months I've noted that Montana had 1 drilling rig operating. As of today, they now have 0 drilling rigs operating. So I would anticipate, especially as we head into winter, that number is going to continue to slide down, most likely. And then South Dakota holding fairly steady, excuse me, August to September. You heard the numbers from Lynn. This is, again, just for those that like the visual representation. I enjoy seeing this and how the month-to-month changes look from September to October. In green, you'd have to get very close or zoom in to see the tiny sliver between September and October. Much more noticeable on the natural gas side. And you'll see here in a few slides kind of my outlook on natural gas and the way it's going to differ a bit from crude oil. And this is certainly a hint of it, right, where we see flattish oil production and some stronger gas production. Slide 4, we'll bop past that. That's just an updated outlook for some of the forecast models for folks. Slide 5, again, with production as steady as it was, the market conditions September to October very steady as well. Not a whole lot of changes. So things, all in all, transportation-wise, especially for crude oil, were pretty static between September and October. You can see the numbers here. The numbers of the pie chart are actually identical, September to October. No changes at all on just percentage basis. You can see that, again, that Brent WTI spread, the blue dotted line on this graphic, trending below that $5 and in fact down in that $1 to $2 range. So again, the economics and over the last several months have favored pipeline transportation out of the region. We're continuing to see roughly 200,000 barrels a day moving by rail, primarily to the west coast. But again, a lot of those are contracted or the economics just favor that particular marketplace. On slide 7, again, very consistent September to October on the crude by rail estimates. Again, just hovering just slightly below that 200,000 barrel per day mark. And then slide 8, no major changes as far as the destination of that crude by rail. PADD 5, Pacific Northwest, continues to be the dominant destination. You'll see here on the next slide what the economics were doing for the September timeframe, which is referencing back to that rail chart. So you can see PADD 1 does have the highest price market, but again, PADD 1, it is a bit more expensive to market your crude by rail to PADD 1 than it is. It's a shorter single carrier to get to the Pacific Northwest, and so even though it's a slightly lower price, the economics in whole favor that Pacific Northwest destination. Slide 10, again, as we sit here mid-December, obviously the numbers have ratcheted up as far as the base market pricing. Some of the spreads, though, still consistent, less than $3 Brent WTI spread. So again, nothing is shifting towards that focus on of more crude by rail out of the region from an elective standpoint. And then we have seen just very incremental, very minor increases in the spread down at the Gulf Coast. And so that does favor a pipeline system like Dakota Access. When that spread is higher between Cushing and all the way down to the Gulf Coast, again, those barrels that can bypass Cushing and get direct access to the Gulf Coast markets. Again, for comparison, there is the LLS market, just about $2 premium over Cushing in that marketplace. So again, those North Dakota barrels have that economic advantage if they're able to make it on that system to that marketplace. No major shifts. Again, just all within the range of normal with the imports, exports, the truck and rail movements between North Dakota and Canada. And then on the natural gas side of the world, again, very static. The overall percentages is 7% flaring. The pieces of the pie, the reason for that flaring did not change from September to October. So again, that is encouraging. The numbers the last couple of months have been very promising for what things are going to look like here in the near future. Again, you can see historically on slide 13, that trend from mid 2019 all the way down to Q3 of 2020, that downward trend. And so I think if we can hit this low plateau or this valley and hold it there, I do anticipate production starting to increase or continue to increase on the natural gas front. And so the challenge is just going to continue to ratchet up moving forward. And then assisting in that gas capture equation is, again, the number of wells that we're getting connected to gas gathering. That black line, it's always a good sign when that is above the red, and that's what we were seeing. New wells selling gas was lower than new wells capturing gas. So again, all positive signs from the midstream side. The EIA updated their pricing from a month ago to this month. It's roughly $1. If you're looking for just kind of a number, $1 increase in their outlook for crude oil prices. This is West Texas. Again, you can see a bump up in the near term, but then flattish and fairly slow, sluggish growth for the next number of years. And so that's what we're planning on in our forecast and some of the expectations for the region going forward. On slide 16, from a gas capture perspective, again, October being the last month before the new gas capture rates go into place from the November numbers. Again, things are very well positioned for the near term. Last month when I showed this chart, my expectations for natural gas growth were fairly flat for the next number of months, but you can see from last month to this month that outlook has changed as some of the pricing information has been updated and gotten stronger as some other factors have all gotten wrapped together. So natural gas, even if we do see crude oil sluggish to flat or even slightly down, I am anticipating continued growth for natural gas going forward. And so that gas capture discussion is certainly not a stagnant discussion. That is something that we're going to continue to have to stay on top of month to month, right? It's going to be hopefully some good numbers here for the near term. But as we look at the longer term outlook, the expectation is, again, understanding the timing of when new processing plants or expansions are going to be necessary. How does all of this fit into the transmission side of the world after that gas leaves our gas plants? How does it find a marketplace? Those discussions are still as robust as ever. And then on the transmission side of the world, I think every month now on slide 19, I'm going to just keep everyone updated of where we're at with the northern border situation with market share for North Dakota versus Canadian gas coming down. And you can see that, again, the last several months that market share is hovering in the mid 70s to at one point in time, 1 week, over 90% of northern border was North Dakota's gas on that system. And that does come into discussion when we look at slide 20 of what's happening with the BTU levels on that system. I noted last month that FERC had rejected the tariff change, and again, I noted that the issue is not going away, and I wouldn't be surprised if we see it come back at some point in the future, because again, all signs are pointing to this being a long-term challenge for the region from a gas marketing and transportation perspective. So we'll continue to keep an eye on this, and as information becomes public, I'll make sure everyone is aware of the situation. So with that, I would be glad to answer any questions.
I'll just ask you kind of what I asked Lynn, and you got at some of this in some of your comments that you just made, but could you maybe provide to us a look back at 2020 and a look ahead at 2021 in terms of some of the things that you track, you know, whether it's oil transportation, you kind of just said about natural gas, or any other insights you have? Yeah,
so when we look at 2020, just from a pure transportation, so on the positive side, the gas capture in my mind is the shining story, right? Going from an environment for the last number of years, really since the Bakken began, of being severely challenged in having adequate gas processing and capture capability. And as we moved into late 2019 and into 2020, that story had certainly shifted. And so as far as a shining sector or piece of the industry, that has been, in my mind, the number one. As far as some of the other major transportation events and stories of 2020, clearly the Northern Border filing was one of the biggest. The others being the Dakota Access and the court rulings and the EIS through the Corps of Engineers, all of that transpiring mid-2020. And then from a transportation side of the world, right? So the midstream sector in general is extremely cautious and risk adverse. And so situations like what happened in 2020, where we see massive fluctuations in the marketplace, add even more uncertainty to what timeframes will look like, what scale of projects are going to look like. So it becomes that hurdle that you have to jump over gets that much higher when more uncertainty is mounted into the discussion. So certainly going forward, what happened this year in 2020 is going to be on everybody's mind of what's the recovery going to look like. There's still so many unknowns, even with the positive news with the vaccines and some demand starting to come back. The long-term story is still been shaken, right, about what global demand will be, what does OPEC and OPEC Plus mean to the marketplace. All those things have really just, we've had to restart a lot of conversations with folks about, what does this basin look like and what are the needs long term. So going forward, that's going to be the biggest challenge is again, kind of reworking all the expectations and making sure that North Dakota stays well positioned as growth continues and is expected going forward. That again, we don't see some of the challenges that we've seen in the past, whether it's for gas capture or crude oil transportation, that those challenges, we can try and stay ahead of them as best we can.
And then just one other thing, you had a slide showing natural gas like production, where you thought it was going to go. I think you said you were thinking it was going to be up maybe a little bit more than you did a month or two ago. Can you just talk about what factors are contributing to a potential increase in natural gas in the near term? Yep.
So again, the question, if you weren't able to hear that online, was what's driving that gas curve higher? So the first and easiest one to point to is that the oil price curves have increased over the last month, and so the number of well completions that are expected as we head into 2021 has ratcheted up a bit. Gas oil ratios continue to be strong. The overall gas production and where we expect wells to be drilled and completed in the core area, those areas continue to have improvements in the type of production that they're receiving at the surface. And so all those coming together have pushed that curve, or it's enough mathematically to make sure that growth is moving upwards instead of stagnant.
What is your thought about the demand for natural gas liquids and where that might go over the next year or two?
Correct. So natural gas liquids, that's something I didn't have anything here to point to, but as this natural gas curve continues to grow, our natural gas liquids production will be ramping up as well. And so we had the study, that was another highlight of 2020. We had our natural gas liquid study completed by the ERC, and that was pointing to even higher NGL production in the future than we had originally been forecasting. So our current transportation network for natural gas liquids is not adequate over the long term. Even with an expansion of one of our major systems down to Kansas, even beyond that, there will be excess production expected. And so those opportunities are being looked at for in-state use. Again, the petchem discussion, power generation, and then the more traditional, if there's not a marketplace that we can be developing here in the region, what does transportation out of the region need to look like? So those are all being discussed as we speak.
Any other questions for Justin? All right.
Okay, great. Thank you.
See you in the new year.
Yeah.